simple, fast steps. Step number one, we need to demystify LIBOR. What on earth is the LIBOR rate? But before we get into that, let's go over some terminology. This big bang that everybody has been talking about is simply moving the universal rate used for lending, and we'll get into that in just a minute, from LIBOR over to something called SOFR, which is SOFR. And that's a rate that they're going to be using just domestically. But let's go over what LIBOR is so we can really get straight on what these terms are, so we can understand what this big bang is and how they're going to be transitioning from LIBOR over to this new rate called SOFR, S-O-F-R. And for a definition of LIBOR, to figure out exactly what it is and what it does, let's go right to Investopedia. The London Interbank Offered Rate, or LIBOR, is actually a set of several benchmarks that reflect the average interest rate at which large global banks can borrow from each other. It's the leading indicator used to price loans and other debt instruments. And the key takeaway is this is an interest rate that's derived not from transactions, but just from questioning other banks. So each morning around 7 a.m. Eastern Time, the ICE Benchmark Administration asks a panel of contributor banks to answer the following question. At what rate could you borrow funds were you to do so by asking for and then accepting interbank offers in a reasonable size, just prior to 11 a.m. London time? So they quite literally just get a call on the phone, they answer the question, and from those questions, whatever they say, they could say 20% or negative 10%, and they just take their word at face value, and they take an average of that, and that's how they get LIBOR. Pretty simple. There are a total of 35 LIBOR rates posted each day. Interest rates are compiled for loans within 7 different maturities or due dates for each of the 5 major currencies, including Swiss franc, euro, pound sterling, Japanese yen, and the US dollar. So it's pretty straightforward, but let's go over a visual. We have 3 countries, USA, 1, 2, 3, and XYZ. Each country has their bank, XYZ, USA Bank, and Bank 123. These are commercial banks, and they don't necessarily have to be in all these different countries. I'm just using this as an example because there's international banks involved with different currencies to calculate each LIBOR rate. So for Bank XYZ, we have the Fat Cat Bankster Wang right there. And in the middle, we have Fat Cat Bankster Bob. And in Europe, we have Bankster Pierre. So basically what happens is some gal or some guy just gets on the phone and says, hey, Bob, how much do you think you could get money from if you borrowed money from Wang at around, I don't know, 11 o'clock today? And then how much would you lend money to Pierre? And Bob says, well, I could probably get it from Wang around 6%. I'd lend it to Pierre around 8%. And they ask Pierre the same question, and he's European and most likely French, so he's very short and disgruntled and just kind of pissed off at all times, especially at those Americans. But he says, well, I'd lend to Bankster Wang at maybe 7%. And maybe they ask Wang what he might lend to Pierre for, but it's just back and forth between the banks, this interbank lending. Then they take the average of those interest rates and boom, that's LIBOR. So here we'd have 6%, 8%, 7%. That equals 21. You divide by 3. Boom, our LIBOR rate for this example would be 7%. But the key here, one of the main takeaways that you've got to understand, and we'll get more into this in step number 3 when we answer the question if this big bang could trigger a complete meltdown of the derivatives market and the entire system. This key takeaway I'm referring to is that the LIBOR rates are unsecured. So when they're asking Bankster Bob how much he would lend to Bankster Pierre, what the interest rate would be, or what he thinks that he could get money from Wang, the interest rate he's referring to is an unsecured rate. So that would mean without any collateral exchanging hands. If Bankster Bob were to give Bankster Wang collateral for the loan, say treasuries or mortgage-backed securities, then most likely the interest rate would be a lot lower. So keep in mind, these interest rates signify a loan that isn't secured with any collateral. And editor, go ahead and throw up this timeline of the Big Bang, or the transition from LIBOR to SOFR. You can see that we started in 2020, and their objective is to completely be off the LIBOR system by the end of 2021. And of course, the big claim here from the central planners and why we need to transition to this new rate is because it's so easy to manipulate the LIBOR rate. The banksters could just get on the phone with each other and decide what rate they want to tell the person calling, whichever serves their purpose best, and they could just say that rate. It doesn't actually have to be legit. So what's crazy is how many loans are actually derived from this benchmark LIBOR rate. And Jeff Snyder, my good buddy, who does a fabulous podcast with Emil Kalinowski called Making Sense. You gotta check it out. But they've discussed this often. And Jeff would argue they're making this transition not really because it's manipulated and they want a better system, but more so the LIBOR rate exposes the fact that the world reserve currency really isn't the dollar, it's the euro dollar. Because think about this, if you're getting a mortgage in the United States, it's most likely going to be based on LIBOR. Well, that's a rate that's outside of the United States. That's not a rate that's exclusive to the domestic economy in the USA. Why is that? Because the majority of the cash in the global economy isn't necessarily dollars, but it's dollars that have been created by a banking system outside of the purview of the Federal Reserve. I don't want to go down that rabbit hole too far. I've done several videos on that. But the main takeaway here is Jeff would say, listen, this is not about a rate that's being manipulated. It's about the Fed saving face. It's about the fact that our economy is built on asset prices, debt, and confidence. And they think that if they move the rate from LIBOR to SOFR, they'll be able to maintain confidence that they are important, that the central bank is actually central to the dollar monetary system, when in reality, it isn't. So what type of loans use LIBOR as a benchmark? I think a better question would be what type of loans do not use LIBOR? We're talking about everything: mortgages, car loans, student loans, business loans, and of course, everyone's favorite, derivatives. Step number 2, SOFR, or SOFR demystified. What exactly is this interest rate? Where does it come from? To figure this out, let's go right back to Investopedia. The Secured Overnight Financing Rate, or SOFR, is a benchmark interest rate for dollar-denominated derivatives and loans that is replacing the London Interbank Offered Rate, or LIBOR. SOFR is based on transactions in the Treasury repurchase market, or the repo market, and is seen as preferable to LIBOR since it is based on data from observable transactions rather than on estimated borrowing rates. Whoa, time out. Guys, I wanted to throw in a quick bonus for you because the main derivative they use LIBOR for is something called an interest rate swap. I've gone over it in previous videos, so I won't go over it extensively now, but I just wanted to walk you through that briefly. Basically, you have Corporation ABC and 123. Corporation ABC has a variable loan, but they want a fixed rate loan. Vice versa for Corporation 123. So they go to the bank, let's say JP Morgan, and they say, we want an interest rate swap. We hate these variable rates, or this guy says, I hate the fixed rates. So what they do is they set up this contract where ABC pays 123 a fixed amount of money. 123 pays ABC a variable amount of money. They actually don't swap loans, but the net result is their payments actually end up moving from a variable to a fixed rate, or from a fixed rate to a variable. The bank gets right in the middle of this, so I'm sure they're charging fees. I have no idea why they would be incentivized to manipulate LIBOR, but for some reason, they can make an additional spread by doing so. And if you want to learn more about it, I'd suggest going right to the Khan Academy on YouTube. Just type in interest rate swap. That'll take you to a couple really quick videos that'll explain it in very easy to understand terms. While SOFR is becoming the benchmark rate for the dollar-denominated derivatives and loans, other countries, and this is really important, guys, other countries have sought their own alternative rates, such as SONIA and Ionia. I think SONIA is for the Brits and Ionia is for the European Union, if I'm not mistaken. The three main takeaways I really want to emphasize, it's crucial you guys understand this, is SOFR is a secured interest rate. So it's backed up by an asset, where LIBOR is unsecured. Therefore, SOFR is almost always going to be lower because it's backed up by collateral. It's not unsecured. Second is SOFR is based on transactions in the repo market. And third is other countries are going to use different ways to measure their benchmark interest rate. In other words, they're going to use a different system and a different infrastructure altogether. So this is an interest rate determined on repo transactions. And I've done a ton of videos on the repo market, but let's just go over a quick overview so we understand how they're getting this rate. Usually what happens in the repo market are the primary dealer banks or other commercial banks, we'll call them A, B, and C. They issue loans to financial institutions and hedge funds that need money for a certain term. Let's call it 1 day, 3 days, 30 days, what have you. It's a contract between the two entities where in this case, the banks will go ahead and lend money to the hedge fund or the financial institution, and the hedge fund or financial institution will give them collateral, usually treasuries, to back up the loan. And then after the term, let's say 30 days, they just go ahead and swap back. So the hedge fund would give the bank their money back plus some interest, and the bank would give the treasuries back to the hedge fund. I also want to point out that it's not just a transaction between the banks and the hedge funds or financial institutions. It can be between banks. So Bank A could do a repo with Bank B could do a repo with Bank C. But we all know what happened last September 17th, 2019. That's when the repo rate shot through the roof, up to almost 10%. That took all the other interest rates up with it, including Fed funds. In other words, the Federal Reserve completely lost control of all of the interest rates that really matter, including their own Fed funds rate. So they had to step in and provide liquidity for the market, which basically means they bought all these treasuries from the primary dealer banks and the banks under the Fed's umbrella and just gave them bank reserves in return, hoping that those banks would take all these reserves, the excess balance sheet capacity, so now they can issue more loans theoretically, and go into the repo market to bring this rate down. Well, that was their goal. And to give them a little credit here, it actually worked. The repo rate did come down. But let's remember what's going on here. Let's really pay attention. What they're doing is they're taking treasuries, they meaning the Fed, out of the system. Whenever they do quantitative easing, as you guys know from watching my videos, all it is an asset swap. They're just trading treasuries that are on the balance sheets of the banking system. They're trading those treasuries for bank reserves. And remember, these banks have accounts with the Fed. So the treasuries go to the Fed, they go onto the asset side of their balance sheet, and then they give those banks bank reserves that are a liability of the Fed and an asset of the banks. They give them those bank reserves in return. So it's just that asset swap, bank reserves for treasuries, but they're taking treasuries out of the system and taking treasuries away from banks that could use them in the repo market. More on that in step number 3. And I know I'm being a little redundant here, but I need to make sure everyone is on the same page because it's crucial you understand the concept. And we'll go over this more in step number 3, where we try to figure out if this big bang has triggered a derivatives market meltdown. But let's go over to this chart of SOFR, the effective Fed funds rate, and the Fed funds target range. Editor, go ahead and throw it up there really quick. And we can see on the left-hand side, or I think on the chart there, it's on the right, it goes from 0 basis points up to 500 basis points, or 1%, 2%, 3%, 4%, 5%. And we start in 2016, go all the way to the end of 2019, beginning of 2020. And we can see as this rate, this is the SOFR rate, and again, this is tied to repo. So it's not that smooth. It has these periodic spikes up and down, and then it kind of levels out. It goes up with Fed funds. But remember how out of control it got September 17th. SOFR went up to 500 basis points, or 5%. So let's think about this. If your mortgage, if your car loan, if your student loan, if derivatives are tied to an interest rate that can go from, call it 1% up to 10% in a day, what would that do to the entire market? What would that do to the debt market? You're starting to connect the dots here? And let's not forget, during the cerveza sickness in March, when the Fed took their rate all the way down to 0, what did they do in the repo market? They committed to doing $1 trillion a day. $1 trillion a day in the repo market. Now, they didn't actually do that many transactions, but they committed to doing that many transactions. And what did we go over in step number 1? What was the rationale that they give us for moving from LIBOR over to SOFR? Oh, we can't use LIBOR anymore. It's manipulated. Well, how manipulated is the repo rate when the Fed is coming in and committing to $1 trillion a day? It's the most manipulated rate imaginable. The central planners are trying to brainwash you into believing they're moving from one rate to another because the first rate was manipulated, when the rate they're moving to is even more manipulated. And I think that once you start putting the pieces of the puzzle together, their game plan becomes crystal clear.